Welcome back to Weekend Mac. We're going to continue to learn about monetary policy. So here is pretty much, we're going to talk about the new types of monetary policy in this video due to the Great Recession of 2007. So we're going to walk you through a couple of the periods and what happened in terms of how the central bank in the US reacted to different types of economic shocks that the economy experienced. And then we're going to explain what was the latest one besides the pandemic, of course, but the one before that, 2007, and how did that change the entire monetary policy scenario through the new types of monetary policy tools that arose. Okay, so this slide just pretty much summarizes everything we talked about so far in terms of the relationship between changes in the money supply, which can be done by the central bank, how they impact interest rates, how they impact then in investment and consumption, and how that leads to change in GDP and the price level. Okay, and that's going to be very, very useful on the next analysis that we're going to do. Okay, so we're going to, like I said, it's going to be a retrospective of how the Fed has previously performed. And let's start with just looking through different regimens. Okay, so there's three measurements we're going to be looking here. We're going to be looking to the federal funds rate. Okay, that's going to be this curve right here, as you can see. Okay, you're going to be the unemployment rate. That's the dashed line. And we also have the inflation rate, which is the thicker line. Okay. So let's see how that has evolved since the 70s. So episode 1 is the one that we talked about in previous scenarios when we talked about stagflation, which is we're experiencing a lot of high inflation and high unemployment at the same time. So you can see here both on the episode 1, both lines, the federal funds rate, the unemployment rate and the inflation are high. Okay. So if that's the case, then how do we react to that, right? Well, obviously the first thing they focus, and we talked about, is that the central bank focus on inflation a lot, because they are really, really scared of hyperinflation. Okay, so at that point, when they had to choose between helping unemployed or helping the inflation to stay, price level to stay more stable, they focus on the price level. Okay, so on episode 1, you can see a hike in the federal funds rate. Right? So you can see that right here. Right, whenever that happens, right away, you can see that the inflation rate was getting really bad. Right, you can see that in the region right there. But that increase in the federal funds rate, which we saw before, would lead to lower GDP growth, right? So it should worsen unemployment, but it should also lower the price level, right? And we can see that happen. You can see a drop in the inflation level right here, but at the same time, you can see through this line right here that unemployment does increase, okay? So the impacts were as predicted, okay, by the model that we saw earlier. Okay, and that was done by Paul Volcker, and he really hiked the federal funds rate from 5% to 16%, as you can see. So very, very contractionary policy. Okay, well, eventually the inflation normalized, and that came to part 2. In the part 2, now we had a lot of unemployment, but the price level was a little bit more stable, right? We had lower inflation. So at that point, it's time to engage into expansionary policy, where we make money more available, lower the interest rates, which can lead the price level to go up, but at the same time, we want to incentivize production. So you can see here the economy trying to bounce around that potential GDP line, and this is done through different types of monetary policy tools and monetary policy that are being implemented by the central bank. So in the second one, you can see if we're going to engage in expansionary monetary policy, you should see a lower of the federal funds rate, which was done in 5 years. Was they lowered pretty much 10%, okay, 10 percentage points, and you can see here that as the federal funds rate lower, you can see the inflation picked up a little bit, but you can definitely see that unemployment also went down. Okay, so pretty much as we expected. Then it came the episodes 3, 4, 5, 6, and 7. So that's pretty much known as a stable. The country was growing, inflation was pretty much low and it was being controlled well. Unemployment was not too bad, but they were still trying to manage it and lower to try to get to lower levels, right? So a little bit more stability than before relative to the 70s and 80s. So in the 90s and early 2000s, there was a lot of deregulation done by Alan Greenspan, the chairman of the Fed at that point, which allowed banks to change their business model. They allowed investment banks to be part of this. They also dropped the interstate restrictions. So before that, banks could only operate in one state. Now it allow banks to expand geographically. Okay, so a lot of things changed. The economy is really changing, especially the banking industry. Not a surprise, the next recession we get hit, we have to create new types of monetary policy tools. Because as you can see, we experienced a lot of change in the 90s and 2000s, which led the economy to change. That's the importance of this class. If you can take this from this class, I'm super happy. Okay, the idea that despite all the theory that we know, despite all the history that we know, we should use that history to help us make decisions later, but not to make a rule about we always have to follow this. Why? Because the economy can change given difference in technological advancements, given that the cultures are evolving, that globalization is coming in, right? Trade is happening more as well. And given all of this, we know that the economy is going to change and we might need to react to it differently. Okay, so one of the things that happened in 2009 due to the Great Recession, which I already talked a little bit about the money and banking chapter, the economy, the financial system started to crash, right? Unemployment started to pick up. As you can see here, right, unemployment going up, and you can see here that inflation is low, right? Inflation is very low. So now what do? Okay, expansionary policy, that is so easy. We're not worried about inflation. We need to lower unemployment. Well, but don't we do that through changes in the federal funds rate? What if the federal funds rate is close to zero? That's the zero lower bound problem, which is going to be extremely important for us in this class and in the macro class and in your life moving forward, because it changed a lot of how the economy works. Okay, so in this case, try to imagine, oh, Eddie, but lower, why don't they go negative? Imagine that intuition. That means that if you have a savings account at the bank, technically you'd have to pay the bank to keep that savings account because you'd have negative interest rates. Would you be willing to keep your money at the bank if you have to pay the bank to do so? Maybe you do, but a lot of people maybe would take their money out. Well, now we're having problems of bank run. So there's a lot of big issues that had to be decided at that point. Okay, and that's why these new types of monetary policy tools came about. So right now, please stop this video and watch the new types of monetary policy tools discussed by the Marginal Evolution video. Extremely good, and I'm definitely going to use it moving forward in this chapter. Okay, so pause and then come back to at this point, and we can continue. Okay, so we're going to walk through just a couple of the new types of monetary policy tools, especially the ones mentioned in the videos called quantitative easing and the interest and excess reserves. Okay, so the idea here is before 2008, we used the most traditional types of monetary policy tools that we talked about so far. But whenever it got to the point that interest rates could not be lowered, but banks were still in trouble and they needed help to be able to get funds to keep operating, then the central bank had to face the question, how can we help them? The way they came up is that they figured out we cannot let those banks fail. They're really big. That would cause a huge disruption in financial markets. We don't want that. That's a huge recession. Maybe go to a depression at that point. Okay, so let's help those banks out. So how do they do that? Well, they decided to engage into this emergency type of lending, which the central bank pretty much bought toxic assets. So rather than borrowing those treasury bonds, which are extremely safe, right now they bought something that the value is going down, because as we know, when the house market crashed, the value of those assets that were tied to that market started to drop, right? We talked about fire sales on the money and banking chapter, right? And if that's the case, you can imagine that if the central bank is buying those assets from those banks, they're getting assets that are lower in value. Right? So that's not a really good trade-off when before they're getting treasury bonds, they're trying to expand the economy. Right? So that idea was extremely new, and that's one of the new types of monetary policy tools. But the idea is that, hey, if we can take those toxic assets from banks, now they'll be better off, and now they can be able to provide loans again to people, and that would lower their credit crunch, which allow business to borrow money, us to borrow more money, and lead to more economic activity. Okay, so they actually did three times the quantitative easing. Okay, the first one definitely had an impact. The second one, research has shown the second and third one had a lower impact on economic activity. So a lot of questions still remain of, hey, how can we help banks provide the liquidity that people want, the loans that people want, right? Because of course, once you give money to banks, they can choose what they want to do with it, right? They're not forced to give out loans. They can do other types of investments. So how to make policy in a way that those loans are reaching the hands of those who need the most, right? That's the tough part. Okay, and like I said here, the pitfall is that if the central bank wants to sell those assets, it's uncertain how much they're going to get back on it. So it's really hard to reverse this purchase of those assets later on by trying to sell them and convert that into money. Okay, so they're tied up with those assets that are now junk, right? So unless they get better, which hopefully they will, slowly with mortgages and housing market adjusting again, right? Then maybe they'll be able to get out of this hole, right? But in the worst case scenario, they need to print money to pay out for their expenses, and that comes in terms of the inflation tax on us. Okay, as you can see, this is all kind of connecting here, and it's getting complicated because the economy is complicated. But that's why we're going to have the virtual class this Monday, and we're going to be able to talk a lot more about all of this in case you have any specific questions. Okay, the second type of monetary policy that's very, very important is going to be the interest and excess reserves. Okay, so another thing that came up during the 2007 is that one, it was hard to expand the economy when interest rates are very low, the federal funds rate. That's the zero lower bound problem. And two, At the same time that you want to expand the economy, you want to control the risk of banks, right? So they wanted to create a new type of policy tool that would allow them to do so, to disincentivize or incentivize banks to give out more loans. And one way they thought about this was through offering interest on excess reserves. In other words, before banks, if they held more than 10% of their required reserves, they earn no interest. They're just working as a piggy bank, or just for security. Now the central bank would pay them to keep those extra reserves. Okay, so by increasing, in this case, by increasing the interest, the central bank would pay those banks to keep more reserves. We would incentivize them to be less risky and be more efficient with their loans, right? Incentivize them to keep those loans, and so they don't get too risky because their money in the vaults would earn no interest. Now it is earning some type of return. Okay. Now the pitfall of this is that some may argue that they can reduce the borrowing too much, right? It can cause a credit crunch. If you keep incentivizing banks to not lend the money out during a bad economic time, then how are the people that really need the money going to get the money, right? The banks are going to focus on safety, and that maybe means more excess reserves and less risky loans for people that don't have a job. Now that's a big question. Should banks be providing loans to people that don't have jobs during the recession? Right? Technically, if you're a profit maximizer, now you're really worried about whether you're going to get paid back, right? So a lot of questions remain. You can see this is a really simplified way to talk about all of this, but you can see how the economy is complex and how it's important to understand how it's evolving, because it can impact the availability of loans, the cost of loans, and the changes in the aggregate demand, and thus production in the economy. Okay. So the idea behind the interest and excess reserves is that during a contractionary policy, they can increase the interest and excess reserves by disincentivizing banks to give out more loans and keeping more reserves on their vaults, right? On expansionary policy, they can lower. They can say, hey, you're going to earn no interest and excess reserves. And if that's the case, then you're really incentivize the banks to loan as much money as possible. Do not keep those reserves in the vaults, right? So that's the idea. Okay, so moving forward, we're going to talk about the pitfalls of monetary policy, and that's going to close our chapter on monetary policy. So stay tuned.